Fortunes are made or lost because of information.
They can either cut interest rates or they can print money.
The key feature here is speed, trying to follow what's going on in the international markets.
The roaring 20s.
We used to laugh at Amazon. I mean, I get it.
That was funny,
right?
Amazon.
Yeah, and we've laughed at Tesla along the way.
Oh, man, Tesla.
Damn it, that's what's happening.
So he had that information prior to anyone else.
If you don't, and they get you, then you lose money.
I listened and I transmitted and I analyzed. There's a little bit of detective work when you hear a little piece of information.
Hello there, and welcome to the Uncharted Invest podcast version. This is the first one of these. I'm Andy Nelson. I'm the co-founder and editor of the Uncharted Invest Magazine, which comes out monthly. And joining me is my co-founder and co-editor, Brian Griffo.
Just a note, this is not investment advice legally. This is just for entertainment. Enjoy, guys. Andy, how you doing, man?
I am great. And Brian, it's good to welcome you to the Uncharted Invest podcast. We are the co-founders and editors of Uncharted Invest Magazine. And today we're going to share our thoughts of what we've been working on, at least in the last week. None of this should be any sort of suggestion on what to do with your own holdings. This is all for entertainment, right?
And I would add to a recording disclaimer that by being here, if we do end up chatting, you will potentially be included in the audio version of the podcast that's being recorded.
So, Brian, we had a number of meetings this week, and a lot of it was about your recent interview with macroeconomist Jeff Booth, author also of The Price of Tomorrow, which we both read. I don't want to even try to attempt to do it justice. If you can just kind of talk to me about your takeaway from your chat with him.
Yeah, so I was thrilled to talk to him. It was an opportunity worth taking, and it lined up well with writing the macro this month, because I think something that hadn't been hashed out perfectly, and you see it in a lot of YouTube videos and conversations, is, are we in an inflationary environment? Are we in a deflationary environment? And I already had kind of like a follow message thing going with him on Twitter. I had just read the book, so it was a natural way to reach out. And then also Robert Breedlove had helped us with, I think, the May issue. And Robert did like an 8-hour interview with Jeff that I had watched too. So there was that natural tie-in. It did work out well. We planned it for 15 minutes, and it went like an hour and 15 minutes. So it was like a Clubhouse. But it was great. It was great to talk to him. And how rad is it to read a book and then just dial up the author?
It's crazy the kind of access that we've had to these amazing people just because we've started this stuff, and the fact that they're willing to participate and hear what we have to say, and the fact that you got a chance to just sort of go toe to toe with him and about your ideas it was a really neat thing to hear. We are going to release that as a separate podcast, the entire interview, which is it's just awesome. And Jeff was so cool to let us do that. And you'll see a transcript of it in the July issue as well. But he wrote it a couple years back before all of this happened, and he is long Bitcoin, but he's really more long just the idea of the deflationary technological advances that are happening in the world will basically eat the system that's in place now. What did you think of that?
Well, that was my biggest question, because following Cathie Wood for so long, and then also following Jeff, I know that Jeff's long Bitcoin, and I know that obviously Cathie is buying GBTC and Coinbase like it's going out of style. And so my biggest question was, how do you and Cathie, who are both very adamant about the economy being deflationary, meaning that technology causes prices to go lower or your purchasing power to get stronger, yet you're long on Bitcoin, which has traditionally been thought of as an inflationary hedge like gold? It seems like those two things are in opposition to each other. And that's really what was great about the interview, is it was almost like him and I were learning the narrative together. We settled on this idea that you have to have a duality of mind. In other words, two things that are both very important forces in the market can coexist at the same time. And it's hard for people to wrap their heads around that, because they just would want one single narrative to make things easy. But, like anything, it's not easy. It's something that you really have to wrap your head around.
Well, like many things in our society today, especially in our country, people take a side, and you ride or die with your team until you win or lose, right? And there's some sort of middle ground there that we're finding ourselves in. That's kind of interesting when you say.
Yeah, and that was the thing too, because the last issue of UI, I think we were both feeling very dollar bearish to the point where I was trading US dollars for boxes of rocks.
Right.
And now we've come back on that, which is slightly embarrassing, but I actually think it's like a sign of maturity and growth to be able to keep your mind open and change when new facts are presented.
You're saying that you're not as much of a dollar bear as you were before this interview, or was that maybe some other things that we talked about this week in meetings?
Yeah, and we can talk about the conversation about Marin Katuza, but before we get off the Bitcoin and Jeff Booth, and I don't know if we had this conversation in a meeting, but what I think is really going on here is Bitcoin should be like gold. Traditionally, when the markets are up, gold is generally down, and when the markets are suffering, gold is up. It's your classic inflationary hedge. And Bitcoin is designed in that way, being hard capped, hard money, very straightforward. But we have not seen that. And I think the reason is it's because it's still in its infancy. In other words, like if gold was discovered 10 years ago, I'm sure there was a lot of volatility. And obviously it would have been upwards over the years. And so I think while Bitcoin finds its maturity, it's going to get grouped into tech stocks and kind of ebb and flow with all of these different market moves. But if it survives in the long term, I think you will see it act more like gold, more like an inflationary hedge once it's grown up. But I don't think we're anywhere near that right now. And so the only other thing I wanted to say on that too is we can't forget that, unlike gold, Bitcoin is a serious technology. And when you look at the deflationary argument, you have to include technology. That's the main driver of deflation, right? And so if you use Bitcoin to remap the financial system, then those efficiencies would necessarily be deflationary. So it's very unique in that it has deflationary forces as a technology, but it has inflation hedge properties as a commodity, if that makes sense.
It does. But so here's really like, what's the end game though? Is it that Bitcoin takes over the dollar and Bitcoin becomes the world's reserve currency and becomes the way that all people exchange value? That's what Bitcoin maximalists might say. Or is there a version of that where the dollar and the traditional banking system and Bitcoin users can coexist? Or does one have to win essentially for one system to work? I guess that's kind of the stuff that Jeff was getting at, right?
Yeah, I don't think it's a zero-sum winner-take-all kind of thing, especially during our lifetimes. You really got to zoom out on these tectonic paradigm shifts. I don't think they really happen within a week or a month or a year or even a decade sometimes.
No.
And so I think like Bitcoin's actually priced like fairly well for where we're at, like in the macro right now. It's not at all-time highs, but it's not at like, pre-COVID or, March, April, May levels either. It's balanced in between, and I think it's actually a comfortable place where if you want that technology deflationary power of its potential remapping, especially with Taproot and some of the layer 2, some of the stuff Jack Mahler's doing with Strike, all this stuff, then I think you can like it for the deflationary technology investment, but it might be a good defense too in the long run, although you need to be prepared for it to get slammed a little bit more if the market, goes 20, 30, 40% down. So, I still think it's a great part of any portfolio, maybe now more than ever. And I think the big thing with Jeff was just trying to figure out and really solidify the fact that we are living in an extremely deflationary environment where specific goods, durable goods, all kinds of assets, might look inflationary and might actually be in a transitory way. So
Do you think that we have a bit of a like a focused lens on this whole thing since we are both long Bitcoin, and we just assume that everybody knows or thinks about it like we do? When I mean, I told you that story about I went to Disneyland a couple weeks ago with the family, and I just looked around and I thought to myself, like, how many people in these lines and these throngs of people actually hold this, know about it, might even know how to get it? You know, we watch this stuff every day, but I mean, it's going to take a lot of people to figure this out for it to really go that way. And I'm hoping for that for sure. But like you said, I mean, we're at the very beginning of this, right?
Yeah, like when you're out there in the world and you have these questions, I think there's the same, like I do wonder that, like I wonder sample size, like all these 100 people, how many really know how Bitcoin works or if they have a wallet? But then I think you could like take that farther. Like you hear a lot of Americans only have $500 to, for an emergency or a car fix or something. Like the fact is a lot of, I think people around the world don't hold hard assets, equities, things like that. And then lately, just to go over that, like even more so, lately I've been wondering how many people even care about anything. Like who's working, who's going back to work? What there seems like is malaise the right word? Or it seems like the whole thing is still in a funk. Is everyone waiting until like stimulus finally runs out, or did it run out? I don't know where we're at with that whole thing. Is it the fall?
Yeah, I hope it's the fall. But I don't, I think it's the fall. I mean, who knows? Everything just seems to keep getting extended, but it seems like everything's going back to normal, quote unquote. I mean, it felt like that when I was at Disney 2 weeks ago. It felt like nothing had happened. Um, and I guess it would just depend on, is it September 30th now? Is that the new date? I know the rent moratorium and stuff has extended here in California. So maybe there's another 3 months that have been added to the unemployment benefits as well. I haven't really looked into that too carefully, but that seems to be what it is, right? The extended unemployment benefits that are making it so you're almost making the equivalent of $18 an hour sitting at home,
Yeah.
which is better than minimum wage, and you can do, you can use your time for other things and still get paid. I mean, is it almost like a test run of the UBI system? It feels like it, right?
And that's the question it leads to, right? But like, even, I don't, maybe my anecdotes are bad because maybe my sample size is just weird people, but I hung out with some people on the 4th of July and they were saying, I'm on unemployment. I'm getting calls about going back to work in the kitchen or do whatever they do. And they're saying, like, my logic is why bother? Because I'm going to make less and have to work. And I don't look at it that way. Like, I mean, for me personally, I just like to get the blood moving. I think when you work, you find new opportunities, meet new people. I think that like it's a really healthy thing to just feel like you're of use and be productive, and one opportunity leads to another, and you never want to sit back until the last minute. But what it looks like on the whole, is that a lot of people are sitting back waiting until the last minute. And so, if we talk about unemployment benefits running out, or we look at even some of the foreclosures that are potentially on the horizon with forbearance running out.
Yep.
I mean, the way I'm doing it in my head is I don't know if people are just in this long pandemic funk, but at some point when the rubber meets the road, you got to go back to work, because if you don't earn money, and then you can't pay your bills, and then you don't have a house and like things that people enjoy. You're on the street. So it's like, is everyone waiting until the last minute to like be forced to make money? All right, so do you think like maybe like the wage, like if the wage rates aren't high enough, you could use that, but then
Yeah, I don't know. It's a tough one because, I mean, this is going to sound weird, but it's almost like a paid vacation, right? Because you're not sitting on a beach or you're sitting in a lounger by a pool, but you technically are paid to not be at work and giving your time and hard-earned work for dollars, right? And so when you're on vacation and I'm on vacation, we don't want that to end, and we'll do. It's like that last day comes, you're like, oh, I got to go back to work, and you have to go back, right? So maybe that's the mentality, kind of what you're getting at, where it's the malaise that you're talking about, because it's a paid vacation. That sounds trivial to say, but maybe that's what it is, right? And it's fun because it is, because you're not doing what, if you have a job you don't like, which many people do, um, maybe that's the thought.
Yeah, I mean, if you go to a great party and the cocaine is never ending, like you keep on doing it, like the night gets late and then eventually you run out and the house is a mess and you're like, oh my God, what have we done? We need to clean up. I need to call my mom and we need to go to church, man. Like everyone like has to wake up and go to church. Not, I mean,
Yeah.
I'm not saying like go to church specifically, but
Yeah.
put on your Sunday best. Let's get to work, America.
Right.
Yeah, these are things we think about.
Well, I mean, then there's the other side of this coin, which we think, the bond market too is a part of this as well, where if it seems to be an issue as well, that's going to be, if all the money's going into equities and we're leading into more debt and margin, it seems like it's another problem as well. If people are not going back to work and maybe buying things on credit card debt or on stock market margin or home equity lines, yeah, you're right. At some point, somebody's going to have to pay for that, right? And are we just living in a world of debt right now? And not just us, but everybody, banks, all of us. That's a big problem.
Yeah, that's huge to flag right now because hopefully we can get this podcast out this week. But we're seeing a potential liquidity crisis due to margin and leverage, right? That's what we're really talking about. I don't know if I got the right numbers, but what I was looking at is there's like a quadrillion dollars in the market, like 10 times global GDP, which is just insane. And so what you have here is you have like retail investors that are working on margin, but you also have banks, hedge funds, you have corporate debt that's junk being bought, just trying to chase any yield. And it's like this crazy system where I feel like the first one that blinks will set off like a cataclysmic domino chain. Because let's just play this out, right? So let's say that I'm highly leveraged, and we looked both at that article about how like wealthy individuals oftentimes just borrow against their equities with margins so they don't have to pay capital gains, and that's all fine and good. But let's say you're doing that and you're doing it for something that's like less than a hard asset, like a boat or a vacation to Disney or something like that. And then let's say like the first shot's fired. I don't know if it's Wells Fargo pulling back personal credit lines or whatever you want to say, but then the market tightens a little more, and then eventually if you have one of these dips, it can become a crash. Now, in that case, you're going to get a margin call and you're going to be forced to sell your underlying equities or add more cash to your portfolio.
Right.
But if you don't have it, you can't do it. And so let's say you're holding Tesla, Apple, Nvidia, whatever. These things, without your choice, just start selling off. And that selling pressure, as we know, creates more selling pressure. And so
in the overall market.
Right. And so as prices plummet, they plummet more. It's exponential. And then more people get margin called. And then this is that coming off that like, third 8 ball of Coke where it's like, it's time to clean up the house. We've really messed up. Like, I think that's the key risk in the market right now. And I don't recall bond markets like having the outsized effect with the slightest moves on the equities market as we're seeing in the last few months.
Well, but the bond market's really dipped. I mean, quite a bit since the early part of the year when bond markets were up and tech stocks were down, and now bond market's down and tech stocks are up. I mean, but back to what you were talking about with the debt thing. Isn't there the flip side of this though, where if you're taking all that debt to then buy more equities, so I'm going to borrow against my long Tesla position to borrow 10 grand more to buy, I don't know what company X, and all of those stock prices go up, but they're not going up because of real dollars. They're going up because of debt. So those prices are inflated. I mean, we'll get into what we see potentially coming later, but there's a flip side of that too, where just like you said, where margin call can happen and people can get wiped out and their things can get wiped out and that drives the stock prices down. Doesn't all of this artificial money or money that's not actually money or borrowed money that doesn't really exist, isn't that what could be potentially causing the prices of things to go up.
This is one of those things that's really hard to parse out, or could be, because the thing is the Fed kind of backstopped the market with buying corporate bonds and different things, and that gave the market a lot of confidence to buy more. So you could look at it and say, the market is overinflated, it's over leveraged, as we just spoke about. But then oddly enough, like when you do like traditional PE and discounted cash flow, like a lot of the technology names are not insane. Some are high. I mean, I can think of a few off the top of my head, but some that are growth, or traditionally beta stocks are perfectly reasonable, 15, 20, whatever. And so, I mean, we had a lot of meetings this week, and I think we both decided to do nothing with careful thought and consideration.
And that's tricky right now when you see some of these names that we like at these low prices, and you see them starting to run again, potentially to, towards those fall, winter prices that they were. And you're like, oh, I'm going to miss it. Oh, I'm going to miss it. Like C Limited was a perfect example of that. I remember I picked that up during the earlier downturn in the year and was excited to have that because it was quote unquote on sale. And then I sold it off to get some more other things when it wasn't moving. And then suddenly now it's back up. And that's just me not sticking to my guns and keeping the things that I wanted to keep. But I saw a different opportunity, and I'm glad that I did it. Long story short, but you're right. It's really tough to navigate right now. So it's almost like you're not sure which way it's going to go. So you and I both decided kind of on our own, and then sort of came to the same conclusion once we met the other day, and just were like, I'm not doing anything. I'm not going to have any margin. I'm just going to hold what I hold. If I see a great opportunity on something that's really on sale, I might get it. I might not. But I don't know. It seems like still waters, and there's a storm coming one way or the other.
It seems like doing nothing is an honest position if you come to it honestly or naturally. It's like there's there's people on the street that are all doing nothing, and a lot of the times the reason is because they're not in the market or they don't have any opinions. But you and I spend 18 hours a day working on this stuff, and I think after that much thought, capitulation, conversations, if we decide that we're not buyers or sellers and we're doing nothing, it's a position. It's just it's a neutral position.
Yeah. And I mean, I just got, because I'm not an options trader at all. I never have been. I've been curious about it and have wanted to try it and wanted to play it in the true form of it, not as a quick dollar, but as actually to hold the price of the things that I like now and maybe get it for quote unquote cheaper later. But yeah, I just got options approved on my main account, and I was ready to go. And then I just thought about it. I was like, And then on the flip side, you had a completely different experience this week with options, right?
Not this last Friday, but the Friday before we started talking about this. And I had longs that were healthy, but I had like quite a bit of margin percentage wise that I was uncomfortable with on options contracts that I loved, to be honest with you. And I had to de-risk because what I was seeing in the markets with leverage and with a potential liquidity crisis, with some different things on the horizon, I didn't want to be a part of the problem I was observing. And in other words, like, it would be my worst nightmare to have a crash and have my broker decide what they want to sell for me. That's not a world I want to live in.
Right.
Now, if a market crash happened and I either had no margin or dry powder, which is where I'm at now, could actually hold the companies that we love that have high conviction in, and then perhaps also add more.
Yeah. And I think that's where we're at. With the option thing, it just seemed like a tricky time to get into it. And then just sort of not do anything after being so active, both of us, for the last couple of months, is somewhat jarring, but also kind of calming at the same time. Does that sound weird to say? Remember, you've been at this a little bit longer than I have, so.
Yeah, I think if, we have high conviction names and we're not on leverage or on any kind of like debt cycle, then there is, I think, some calmness to letting it come as it may. And I'm not sure that there would be a crash. I mean, honestly, the market could, double up and we could feel bad for going conservative, but I think as a matter of practice, it's really healthy just to run your portfolio and your investments like that with very tight to little margin, and earn the money that you make and put it into the things that you have high conviction in. And if they say it all the time, but buy as low as you can and sell as high as you can and hold as long as you can, and that's it.
Yeah, and I mean, shouldn't we always be prepared for something like that? I mean, every single day, somebody says on some outlet somewhere, whether it's YouTube, whether it's CNBC, whether it's Yahoo Finance, somebody's going to predict a market crash every single day. And one of the days, that person's going to be right, and they'll make a career out of it, right?
Yeah.
But until then, I mean, we should be prepared for it, I would imagine, especially with as volatile or as house of a card situation we have in the market right now, it seems. But the other part of it is, and you and I were talking about this, and this sounds crazy, but aren't we kind of welcoming one in a way where if we did have that dry powder, if we did have a little bit that we could, peel off and turn into something else and get some of the stuff we really like at a discount, that sort of like contrarian idea of like, oh, I love it when it's low, but it's weird. I wouldn't have a problem with it. Does that sound strange? Because we're long, right? We're long all these companies.
Yeah, that's the paradox. Like I always want to add more Tesla. So on one hand, I'm rooting for it to always go up because that always makes happy day. But the flip side of the coin is if it suffers, then I'm a buyer and I can add more shares of a company that I love to my portfolio. And so I think that's a good position to be in where you're happy either way. And that's fine. The place you can get to, which is interesting, is you can think, well, why don't I just sell everything, work out the taxes, have the dry powder, and then wait for this crash that's inevitably going to happen? And the reason I think you don't do that is the same reason you don't wait until you find the perfect Bitcoin price. It's like you need to be in the markets to be in the markets. You need to follow it, track it to some degree, depending on how serious you are.
Yeah.
And that practice of being in the loop, working hard for income, keep income coming, and then, try to increase your positions and your assets. I think that the practice is healthy of staying in the market, and, you can see a correction and know it's just a correction. So it's that time preference thing. It's like, if your dad asked me if he should buy Palantir, I maybe no, my mom's 72, yeah, maybe not. Why don't you hold some dry powder for groceries? But if you have a 5-10 year time horizon, I think you can, suffer a lot of dips and enjoy a lot of highs and hopefully hope for higher lows and higher highs. That's, I think, how we got to do it.
That's funny you bring that up because my dad is just over 70. And he holds a large amount of Tesla, which is kind of funny. But he said, I didn't buy it for me. I bought it for your kids. He bought it for my kids because eventually all that's going to go to them. So I thought that's kind of a cool mentality as well when you get to a certain age that maybe you start thinking that way. When most people go into sort of, wealth preservation, that he still had some dry powder aside that he wanted to, and he's lucky enough to do that, to kind of be thinking long term, and he can kind of enjoy the ride because he's an engineer himself, so he's rooting for Elon, and he likes to see all this stuff happen. And so I don't know. I guess it just depends on who you are and where you're at, right? But the real takeaway for us is, at least for us, it just seems to be we're playing kind of a conservative sort of side right now of this, and not really being aggressive just because of the amount of uncertainty there is. Would you agree with that?
Yeah, and on your dad, I think maybe it's not a bad buy on Tesla because we spoke about this in the last meeting, but I mean we can talk about production numbers, delivery numbers. We can look at how the solar roof is doing or this or that. But the elephant in the room is FSD. If you get automobiles to consistently, safely drive people without human intervention, Tesla's the biggest company in the world.
Overnight.
By market cap, culturally, actually, in every fucking way. And I'm sorry, it's a 10x from here. That's a $6 trillion, $7 trillion company.
Yeah.
Yeah, I woke up at 4 a.m. to check Omar's account. I was like, I gotta see everything. It looks like the UI is really nice, and it seems like there's, a smoothness to it. But I'll let someone else that, has a beta test probably speak on that more. But that's what I'm most excited about. I think if you're in this stock, you're in it for that. If you were a new investor that never owned a share and you asked me today, I'd say, well, yep, you're not in it like to the point where it's going to be like a brand new, everyone realizes that this is the future play, but I still think the street doesn't understand the outsized effects of computer vision autonomy. And the worst mistake you can think is, oh, something is very big, it could never get bigger. People thought that about Amazon. I was buying it in 2014, 15, whatever. It did well, So big things tend to get bigger. It's that flywheel. If you have money, you can make more money. And if you've got great engineers and great technology and vertical integration and leadership, go down the list with that company, this is not going to be a surprise if it goes from, what's the market cap now? I don't have it off the top of my head.
Probably 700 billion.
Seven? Is it
something around
Bill?
there? Something somewhere. I'm guessing. Yeah, it's exciting for sure, and especially what we saw over the weekend. And the 2 more weeks thing is not 2 weeks anymore. It's actually closer because we actually have seen it now. So that's pretty neat. So I want to switch gears a little bit. I want to make sure we give time for the Patreons to ask some questions because we're excited that they're here and listening live to us do this.
Sure.
And you get to hear it's like you're listening into one of our meetings over this platform, which I think is what makes this so cool. The other thing that we would be not doing ourselves and our Patreons do service if we didn't also look for other things outside of the things that we love so much. And that thing has really shown itself, I think, over the last 2 weeks as you first recommended the book Rise of America to me by Marin Katusa. And then we both recently watched, or I guess listened to, a podcast where you hear him talk about his ideas for an hour. And we'll link that to the bottom of this podcast when it airs. But it has turned us from dollar bears to potentially dollar bulls. And there's a whole nother thing that we're starting to really look into that may be one of the next big things for us to really dive into. I'll let you take it from here as far as this part.
Yeah, I wanted to talk about that with you. And also, I want to mention that we're not off the uranium trade either. That's
no way. We're still 100% of that.
I'm tracking spot every day. I think that that's slowly and suddenly. The people I talk to say it can run sideways for 2 years and then, overnight, literally the spot can jump, 2x, which is, we've talked about that too, where if you are a uranium miner and you can make money at $45 or let's say break even, then that move from 45 to 46 is 100% of your profit. So 46 to 47 is 200% of your, and then, so this is not like, you can't look at spot doubling and then say, oh, okay, these, holders of the commodity and miners are going to make twice as much.
And just to be clear, what you mean by that is if somebody looked up the spot price of uranium, so what it was trading on the commodities market, and it was around that number, it's around what, 36, 37 now, or 35-ish, right? So
I thought I had it at 32 and a half, but yeah, it's in the
maybe
30s.
You're following it much more closely than I am, but yeah. But that's when you say spot, that's what you're talking about, and that moves some of these equity names quite a bit.
Yeah, and then with that, there's obviously like the term price, which is the price agreed upon with the utilities, which is generally higher, and that's a hard number to get even off Bloomberg. But in either case, the spot is a good kind of like lagging indicator of where the market's going, and it's just been crawling upwards. But if it goes, then you're going to want to have speed dial on all the companies and different plays that we like there. But I just wanted to mention that because I know we're going to get into this Katusa business, and I don't want people to think that we just get on one kind of investment thesis and then ditch it for another. This isn't a replacement. It's just kind of additive.
Yeah, I mean, we've talked about our puzzle pieces in the corners in the first issue that we did back in April, and we still have those same 4 pieces. And if you know us well enough, you know what those are. But I feel like we're finding a little fifth, like meaty center that we're really starting to dive into that could be another cornerstone of our sort of big investment ideas. So go for it.
Yeah, I mean, I don't want to sum up a book that's very long that I have not read more than half of yet, but I'll try because I've done a lot of his podcasts and I've skimmed through some of the appendices and done a whole lot of work on carbon credits, even going back to, I think, early in the year. So, yeah, this isn't just out of left field. This has been, pretty much a 2021 research project. But this book kind of shook myself, and however much you've read, I think just as well.
About halfway through as well. Yep.
Yeah, and I think the general premise here is that he's saying, wait, before you call the dollar dead and inflation inevitable, let's look at everything realistically, specifically, and then also on the macro. And the basic contention is, and this is something that Jeff Booth kind of not verified, but, agreed with me on, that, perhaps the dollar would have gotten much weaker with all of the QE, the printing, but what happened during the pandemic at the same time is that all of the countries around the world that wanted to flock to safety went to the dollar.
Exactly.
And so that lifts up something that would have otherwise gone down. And I also think too, and he's also in the school of deflationary technology being an overwhelming force, is that the Fed almost has to go nuts and print and do QE to try to balance out the books, or else we'd have problems in 100% deflationary environments. So it gets a little bit more specific. I didn't really know about the credit swap lines, which is interesting. So there's favored countries. I think it's a list of 14. And if you have it, you live off it. If you don't have it, you work for it. But it's a way to inject the US dollar overseas directly without any exchanges, funny money rates. It's just direct infusion from the US government to one of those member countries to have dollars available at the ready. And there are certain countries that are far from getting credit swap lines. There are ones that are very close, and then a lot of the ones that you'd think are on the list. I don't have it in front of me, but it's, is it Canada, UK, Japan? Is it Australia? I know India wants to.
Brazil was in there, I think.
Yeah, I think geopolitically they'd want the biggest country in South America, so that makes sense.
Yep.
But yeah, he makes this case that, even though there's been a lot of QE and printing, it's still, basically the best of the worst, and it's not going anywhere anytime soon. And so there's 400 pages that make this point better than I can on a podcast, but
sure,
it's very convincing. And he doesn't seem like he's a big fan of modern monetary theory, MMT, or a lot of the things with the, it's basically monetary and fiscal policy fusing. So we've gone from Keynesian economics to kind of this fiscal monetary coordination to, if this doesn't work, full on MMT, where we can print money and we don't really even need to call it debt because it's an investment in the future. And it gets really abstract when you get into the hardcore MMT stuff. But
yes,
aside from that, the point he makes, which is an interesting one, is that the carbon market, specifically carbon cap and trade, carbon offsets, free market carbon trading, could and most likely will be a $16 trillion industry. This is not some esoteric small trade. This is bigger than oil and Bitcoin and everything altogether.
And it's already here.
And it's here. And it's been voluntary, and it's been the Wild West. And if you had a farm, you could make up some BS carbon credits and sell them on the market for people just to put a certificate on their wall and feel happy. But now we're finally at the very beginning of a real market. So for instance, California, New York has a carbon market, as does the EU. China's coming online. And the basic premise is that you either build your factory or your business in a way that's carbon neutral, or if you don't and you pollute, then you just need to equalize by buying carbon credits on the free market. and those cost a different amount depending on the market you're in. I think maybe $20 in New York, maybe 50 in Europe. I don't have those numbers right now, but it's something like that. I think Canada's mandated that it has to go up to 170 or 80 by the end of the decade.
Right.
And so as companies become more ESG, environmental, social, governmental,
Yep.
yeah, they want this ESG score on their, annual report. It makes their customers feel better, their shareholders feel better. In fact, I think Apple just bought like 20 years of carbon credits.
Microsoft a bunch too, I think. Yep.
Yeah, and so this is an increasing trend. And it's a very difficult trade because there's not a lot of inroads that are obvious. Something that you and I have been playing with for a while is the carbon ETF, KRBN.
Yep.
And yeah, I mean, you basically have to go long on carbon to short it. And I look at the risks as being like a carbon capture system, which would be amazing. I don't think it's going to happen this decade. If it does, then we may have lost money on the carbon trade, but the earth will be a lot more pleasant. So that could be great.
I'm all for that.
Yeah, and then the other, I think, risk would be if governments get the idea to not let the free market do the carbon trade, but actually just tax local jurisdictions and companies accordingly to how much they pollute, in which case you could see a weakening of the carbon market. But this is the early days.
So explain the other side of the trade, meaning, but the carbon credits just don't mandate. There's not an infinite supply of them, right? So
Right.
we're on the other side of the trade. So we would buy a carbon credit for a company to buy from us is the idea, correct?
You could buy and sell, so you can trade them if you are licensed on the exchange, which I'm actually working on now. Or there's also, so it actually has like kind of a stock to flow. It's a giffen goods. So when it increases in supply, increases in price, it's odd, but you need to create these carbon credits. So the idea basically is if I have a factory in Germany and it's putting out X amount of carbon tons of pollution, then I want to buy back a project that saved that many carbon tons of pollution somewhere else. Because this is a global trade, right? So it's like, I mean, Germany and South America are a lot closer when you think about us all just living on the same planet. It all kind of gets like thrown up into the atmosphere and we need to deal with it. The borders, the Earth doesn't really care what borders we drew on the map. It's Earth.
Right.
And so, yeah, it gets really specific. Like you'd think like, oh, everyone's just planting trees, but you have to plant like 50,000 trees like per person for 50 years just in America just to balance out like your own carbon footprint. So that doesn't really work. It's fine and good, but really there's a lot of like oceanic forests and mangroves. They call it blue carbon.
Right.
And that's really a way to, like mangroves, for instance, like they're good for natural habitats, animals, flora, fauna. They would do maybe like 10x, like the amount of carbon credits that like planting trees in Wyoming would. So you basically now have to get these carbon credits that you create audited by someone who's been vetted and respected in the industry. And then those credits are legitimized. They get recorded onto a blockchain. And then they can be traded in the open market. And if you're long on this trade, you just try to buy them and hold them. If you're Nike and you want to do good, you have to burn them. So you buy them and burn them, which just means we bought them, we used them, and we offset what we did that was wrong, if that makes sense.
So it's a lot to explore. It's a lot to look into more. We're both in it in the early stages of it, just through the ETF. But would you call this if you zoom all the way out, would you call this an investment in climate change?
If I ever thought the Tesla investment was great because I thought it was going to make a lot of money and long term it was going to be good for the planet, I don't see this as any different.
And I agree with that. And if this planet is to survive, whether or not you believe climate change is real or not, it only makes sense to do something like this to make things better. And if it starts putting pressure on companies to be more carbon neutral, because they'll start putting labels on things about how carbon neutral these companies are, just like a Yelp review, you know what I mean? It might start pushing this globe into a positive direction in that regard. So I'm in on it. So Brian, just the week ahead, week of July 12th, markets open here in the morning. We talked about it being earnings season coming up, and we start this week with the banks. But the big news that kind of came out over the weekend that we picked up on was Wells Fargo's shutting down personal lines of credit, like your home equity lines. They're just eliminating those, and that's a telling sign of either banks worried about debt and they not being able to make money off of personal lines of credit because of interest rates, or that Wells Fargo, who typically has trouble, is having trouble again. What are your thoughts on that?
Yeah, I wonder if it could be the beginning of a signal that there's some tightening across the market, but it could be just a Wells Fargo thing. They could just be looking at it like we make more money off credit card loans. Let's just tighten up and do that for our own company specific reasons. But it did seem to catch a lot of observers off guard over the last couple of days, and a lot of people are looking at it as, a potential red flag and stuff like that. So I'm going to be watching that closely.
Yep.
Anything, I think on the last Clubhouse, I was saying how I was working with horses and a fly kind of flew past the lead horse and the whole band freaked out and went a certain direction. Yeah. And that's like kind of what I look for, is like that first fly touching the lead horse's nose. And I don't know if that's Wells Fargo or if that'll be something different, but anything at this point I feel like could be that fat domino that kicks the others over. And I don't want to be a doom and gloom guy. I'm like one of the most optimistic people. I'm always bullish on everything. It's just right now, unless I'm reading everything wrong, it looks like there's just way too much debt.
Yeah.
I mean, that's all we have is credit and debt. And we just amp up both sides of the same coin until finally we have to correct. And it's just like we've done this before. I mean, if you think about like 2008 and like the great financial crisis, I mean, everyone knows the whole story there. You had like basically subprime loans that were far less than ideal, basically junk, get mixed in with mortgage-backed securities that no one knew. No one actually knew what the hell was going on by the end of that whole thing. But that really was just a bunch of debt that was unqualified. And even though this isn't houses this time, the housing market got a lot tighter with mortgage requirements. It's still the same thing. It's still people doing coke at the party, taking out debt that they can't pay back. And it's like at some point, once the first bank calls it, it could set off a chain of serious liquidity crunch. So it's like, I don't know if it's Wells Fargo. I don't know if there's going to be others. But it's something to watch for sure.
Along those lines, I'm also going to be keeping an eye on the BlackRock earnings, especially if they talk about how much real estate and single-family homes they snatched up. Whether or not that'll be in the report or not, we won't know. CPI reports coming out, report from June. They're expecting another 0.5% increase, just like we had another 0.5% up in May as well. That wouldn't surprise me. It might even be higher. People are going to scream inflation, 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 but is it transitory? Cathie Wood thinks one thing, Jeff Booth thinks another. But I think in any scenario, I would imagine that the CPI would be up. Although, lumber's down and a lot of these other things are down. Maybe it's just the retail stuff that they're really thinking about here. What are your thoughts on that?
I think even if the CPI is an incorrect measuring stick, it's consistently incorrect, so it still can kind of give you a clue of what the hell's going on.
Is it just something that gets released every month that people go like, oh, and it just moves a market just to move a market? Or is it really something we should be paying attention to?
Well, the problem is it's like they pick the basket of goods, and then it's like, well, is that the basket we should be using? What really matters? Like, you could have a world where you have inflationary consumer discretionary, but then it's not, in durable goods or assets, and it can be all over the place. So I just always thought the CPI was narrow. And then I was trying to do like some gauge theory math on this whole like Eric Weinstein thing about gauge theory and how they're actually not tracking it correctly because they're using the same metrics all the time, when in theory, like the macroeconomic landscape is changing. So people's needs in the market are changing, so it's not using like the mathematical gauge theory correctly to actually track it to be worthwhile. Like, his pretension is that like no one actually understands economics in the field of economics, which is quite possible, because I don't know. I've heard so many differing theories right now from who are supposed to be like the most, well-respected minds in our field, that I feel like there's like a slight chance that no one actually knows what the hell's going on.
Well, do you find ourselves following the macroeconomists that we like because they tend to agree with what we agree with? The Jeff Booths, the Katusas, the Raoul Pauls, the Ray Dalios. Are those the people that we're listening to, and are we doing it in an echo chamber? Or, to your point, I'm not seeing the other side of it either, but I'm really not knowing if I'm looking for it. Does that make sense? Is that a fair question?
That's something that you're always trying to do, right? Is like not get that
caught in the YouTube algorithm. You don't want to be in that. Right?
Yeah.
You want to be able to see both sides.
I mean, I don't look for people who have the same opinions as I do to make myself feel like more dug in. If anything, we've shown over the last month that we've flipped, from being dollar bearish to dollar neutral. That was a huge shift. Like, every morning I try to wake up and be like, it's possible that everything I believe is shit. Like, I'll actually sign out of YouTube to get on a different track and just not get the same feed. Or like lately I've read like 6 or 7 books. Like, get back to the hardcore reading. It's like a lot of this stuff is just siloed, and you have to kind of have mental elasticity and actually be able to like look at different points of view, question your own, and figure out what's what, because it's very easy just to get into a channel of your own thought and then get confirmation. And so, yeah, I mean, I think we're trying to do it right. Like, Elon Musk is my hero. I think he's been bad with Bitcoin.
Yep.
Like, Cathie Wood is already an investment legend, and I question some of the stocks she's purchased and the way she's gone about things. Ray Dalio has always been a hero. He was very late to Bitcoin. Like, I can tell you a negative for everyone that I love. Like, it's fine. It's like, it's not binary where it's like either this person's like completely good or they're totally shit. Like, a lot of these people, they're 80%, 90% on it. Like, I love Lynn Alden. I was listening to her talk about Tesla. I was like, this girl does not understand this company, which is okay. I mean, she can't track everything. She's investing in commodities and crypto and looking at like inflation and Fed rates and things. So it's like,
yeah, she's on another level. Amazing.
Yeah. But there's, going to be a flaw in that too, just like we have our shortcomings. So yeah, I think just keeping an open mind is good. But the CPI, it will matter. These things that are announced, like these headlines do create waves, right? So like you could say it doesn't matter, but then if everyone hears it and reacts to it, it does matter. It's kind of like when the Fed says something, like people react even though they didn't really say much. So then the thing that they were saying becomes real. I don't know.
We talked about it earlier, but you saw Tesla FSD. I saw Tesla FSD, the Twitterverse, that we're in that echo chamber. Everybody's excited about it. What do you think the market's reaction to that will be? I don't think there's going to be much movement, as much as I'd like there to be. I don't see it.
I don't think the Wall Street's like hanging out on our Twitter sphere trying to check out videos at 5 a.m. of an improved UI and how people say it feels. They should be doing their work. That should be like the new auto analyst. Like, don't follow like the legacy format that you've done for the last 30 years. Like, they should be on social media tracking this stuff. It's like the biggest story in the auto space. It should have a huge outsized effect. Like, it looked mostly good to me this weekend. Like, the stock should be up, I don't know, 8% on Monday because of it, but it probably won't, because it's just, it's a hard narrative to really, the news is going to wait until they're like, look at this story. You can now sleep all the way from LA to Vegas legally. That's when it's a story. And until then, it's all just stuff that we track.
Last thing, I got up this morning and watched Richard Branson fly in Virgin Galactic and into space for 2 minutes and come back down and land safely and get out. That was pretty cool. I used to invest in Virgin Galactic, and I got out earlier this year when they kept doing a bunch of failed launches. Do I wish I was still in it? Do I wish I was still in it? No. I like the idea of space tourism. It's not something that I could ever get behind because I'll never be able to do it at those prices. But I like the idea of what it does is it kind of pushes the space narrative. I mean, we basically are watching two billionaires see who could get to space first, and Branson won. I think Bezos goes up, on the 19th? So that's this week or next Monday, maybe. So, but I think the thing that's cool about it is all of those space stocks that we're looking at in the first issue that we put out have really started to get some attention now. Are we doing? Is it not SPACs anymore? Do we think we're going to start seeing some of these space stocks that we like maybe make a run? Does ArcX get a run? I mean, Astra, the ticker flipped on that, which was HOL, and that flipped last week, and that's doing well. And maybe FactQ, which will turn into Rocket Labs, could start doing well. I think people are going to start paying attention now that space seems to be attainable. What do you think?
Yeah, I even noticed an uptick like last week, maybe because it was in the news more. There have been more news happening, but they were kind of like running sideways flat until I think, maybe last week I saw it move a few percent to the upside. So yeah, the more these stories happen, the more it's going to create consciousness in the market. But, eventually once we start building things in space and it becomes an economy and you have earnings, hardcore bottom line earnings, I think that's when it matters more. Of course, SpaceX does, but that's private, so that's not really in play. But it's an exciting space, and I don't want to throw dirt on what Branson did because, what did I do today? I sanded barnwood. He went to space. Well done, for sure.
Yeah, I wish I could have done it. It looked pretty fun. So that, I guess, wraps it up for this one. I'm Andy Nelson. You can find me on Twitter at AndyNelson76, and he's Brian Griffo.
At Brian Griffo on Twitter. The Tesla Wolf. Our website is unchartedinvest.com.
And don't forget, this is not investment advice. This is just for entertainment purposes only.